Hey everyone, my name is Prithvi and welcome once again to the YouTube channel of Backstage Millionaires. In this video of Startup 101 series, I'm going to be talking about IPOs for a startup. I'm going to be talking about the definition of it. I'm going to be talking about the process of it. I'm going to be talking about the advantages as well as disadvantages of an IPO. But before I get started, I really want you to make sure that you're subscribed to our channel because YouTube analytics tell us that more than 75% of the people who are watching our videos have not subscribed. So it really works as a motivation for us if you are subscribed and if we see that subscriber count going up. So if you have subscribed to our channel already, thank you very much for that. And it'll be really great if you can help any of your friends or family members to subscribe to us so that we can keep on bringing this kind of content for a long period of time. So now getting back to the video, as most of us would know, IPO stands for Initial Public Offering. So this is the first time that a startup or a company goes out to the public to sell their stake and to raise funds from the public. So what is the difference between a private company or a public company is obviously like when you are a private company, when you are raising funds from either an angel investor or friends or family or let's say VC firms, you are a private company because you are giving certain set of people the right to own a stake in your company or to invest in your company. But in the case of a public company, anyone who is registered with the stock market, the stock exchanges, can just invest in your company and become an owner. So in private companies, obviously, like because there are only a certain set of people who can invest in your company, the investment size, the amount that they are investing is usually very, very high. Like it could be in hundreds of thousands of dollars to millions of dollars, depending on how much amount you're raising. But in case of a public company, anyone who is a listed stock market trader, they can just buy one share of your company, which could be $1, which could be $5, or which could be $100. They could just buy one share and they can have some stake in your company. So that sort of really gives an option to entire world or to entire population of that country in which you're listed to own stake in your company. And that really gives you a very, very big chance to reach out to more and more people without really convincing them to invest a very large sum in your company. So apart from that, like why a lot of people go to these private investors and not really public directly is because let's say you are just a new startup and you are just starting and you don't have a lot of revenue to show. You are just an idea stage startup. And so in those sort of cases, it becomes very hard to convince these people, the general public, to invest in your company because you do not have a track record. And in a lot of countries, in a lot of stock exchanges, it is not possible for a new company to get listed. So in those sort of cases, you go to these angel investors or the VC firms because they keep on investing in early stage startups. So those people will understand your journey. Those people will understand your company and they are more likely to invest in a new startup than getting publicly listed. So once you obviously have a track record, once you have a bit of revenue, once you have a bit of profit, so then you can certainly go and list yourself as a public company and then you can ask people to invest in your startup. Talking about the advantages of IPO, obviously, like if I just talk about that with an example, Happiest Mind Technologies is the one of the latest tech companies to go IPO in India. So when Happiest Mind was listing, so they had set the price of one of their share at 166 rupees. So this was the price that the company thought people would pay for their share. So but because a lot of people showed interest in buying the stake of their company, because it was like the IPO was oversubscribed by over 100 times. The moment that this share was listed onto the stock exchange, this was listed at a price of 370 rupees, which meant that the market cap of this company was boosted by more than 2 times within a span of like a few hours, within a span of a few seconds, the moment it got listed. So this is one of the biggest advantages which a public company provides, that if there are a lot of people who are interested to buy a share and if there are very less number of shares available onto the market capitalization or the stock value of your company goes up. And that is actually one of the cases why you see a lot of these big tech companies, if you're talking about globally, we see Tesla, we see Microsoft, we see Apple. These companies have really grown in their market cap in a matter of weeks or in a matter of months. So talking about this term called market cap, so the moment till the time your company is a private company, it is a valuation of a startup or a valuation of a company. But the moment you go public, that valuation turns into market capitalization. Now talking about the disadvantages of an IPO is obviously like because you are a public company, you have to keep everything very, very transparent. You have to release your financial data every quarter. You have to have a board meeting every quarter or every year, and then you have to sort of release it to the public that what you decided into this, what is the vision of your company. So this sort of gives a lot of compliances. This sort of makes you accountable to the people who have invested in your company, the stockholders, the stock market traders who have invested, who have bought the shares of your company. it makes you accountable to them. So every single time, every single quarter, you have to go to them and you have to tell them that this is what my company is up to, this is what we have plans. So this sort of like, because it is so transparent, it does increase a lot of compliances. And also because let's say there is one thing which goes down, there's a decision which goes down, which goes like, which doesn't really go your way. So in those sort of cases, the stock market value can just crash within a matter of, again, seconds or hours. So that is another thing, like it really becomes, the company structure really becomes fragile. Every single decision which is taken into a company can adversely, or can sort of maybe help your company's market value to boost, or it can even crash that. So this is one of the disadvantages, because every single time, every single decision, you have to share it with the public. This is not really a case with when your company is a private company, because then obviously if you have raised your funding at once, if you have raised funding, like I give you an example, if you have raised funding at a valuation of $5 million, and if you are not planning to raise any funding for next 1 year, so the valuation really really remains the same. And in the case of a private company, you do not really have a lot of people to give answers to. You only have a certain set of investors who have invested in your company. You only have to tell them that, okay, this is what which is going wrong, or this is what which is going right in my company. But in a public company, you are accountable to a lot more people. So apart from this, obviously, like the compliances, obviously you need to have a legal team. Now you need to have a lot more people who are managing the finances. Apart from this, there are no certain disadvantages of having a public company. Now, talking about the process of a company and the procedure of going for an IPO. So the procedure basically depends from country to country, from stock exchange to stock exchange. Talking about India, India has a regulatory board called SEBI, which is Security and Exchange Board of India. So you need to take approval from them before going for an IPO. They certainly look at the track record of a company. You need to be profitable in India to go IPO, and that is one of the major reasons why a lot of these big companies like Paytm, Ola, and Flipkart have not gone public in India, because the Indian regulations need you to be profitable as a startup before you can go and get listed onto a company. Apart from that, there are like a lot of these compliances that you need to follow before you can go IPO, before you can go public. And these rules and regulations you can certainly find on the website of the SEBI. And apart from this, like this is like every single country, every single stock exchange. So in India, we have two major stock exchanges, which is Bombay Stock Exchange and which is National Stock Exchange. So you can choose like which board you want to get listed on, whether you want to get listed on NSE, whether you want to get listed on NASDAQ, whether you want to get listed on the Singapore exchange board. So that depends as your company's strategy. And apart from that, so this is the procedure that you certainly need to follow to get your company listed. Well, so this was my video on IPO. If there is any suggestions or any query that you have, feel free to write in the comment box and I'll be more than happy to reply to all of them. And please like and share this video and subscribe to this channel so that we can keep on bringing this sort of content to you. Thank you very much for watching this video, and I'll see you in the next one.